Please note that this information is of general nature only and has been prepared without taking into account your particular financial needs, circumstances, and objectives. While every effort has been made to ensure the accuracy of information, it is not guaranteed. You should obtain professional advice before acting on any information shared in this podcast. Now let's dive into today's episode. Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today we have one of our favourite guests, a guest that has come on our podcast multiple times in the past, Martin Lakos, formerly a division director of Macquarie Bank, an employment he held there for over 30 years. He's now doing some independent work, and we loved in the past his focus on data and analytics. And so we wanted to bring that context, you could say, into the recent discussion of the federal budget. We thought Martin would be a very relevant person to discuss the recent budget changes, on top of also a bit of a macro lens to the global economy and local economy. So in the past, Martin has shared insights and analytics from a macro view on the economy. We'll do that again, but we'll do that towards the end of the podcast. To start off the podcast, we'll probably go into all the various changes of the federal budget, how we view them and what we feel they'll likely impact, and then we can talk about the economy. So, Martin, welcome aboard again.
Theo, thanks so much for having me back.
So, where do we start? Let's talk a bit about your shift firstly in that introduction. Like I touched on, formerly at Macquarie for 30 years now, and now you're out on your own, which would be a big change.
Yeah, it is. It's actually 31 years. I left in October, and I've really taken some time to have a bit of a separation from the usual very hectic work perspective, and so it's been more of a life balance perspective. But I'm, as you've said, I'm getting back to it. I'm getting myself back on the speaking circuit, so to be able to present, those analytics you talked about, MC events and functions, and boardroom lunches as well. And you might even find me back on doing a little bit of media, Theo, going forward from here. But I'd certainly call it semi-retirement. It's not retirement just yet.
Well, we'll keep you working here. Don't worry, because we always love your insights and your views toward the topics that our listeners love to hear about. So let's kick things off. Let's dive into the deep end, straight into the federal budget, the hot topic that I've never seen a budget get so much, I don't know if backlash would be the appropriate word, but attention. It's definitely the most disruptive budget I've seen in my time in financial services. It's probably being described as the biggest structural shift in taxation and housing in decades. Probably going back to the 1999, the Costello changes to CGT was probably the last time we've seen something as aggressive as this.
That's right.
And then before that, Keating in the late 80s with negative gearing, which didn't actually make legislation, right?
No, he tried to implement it, but again, that same backlash. Basically, they withdrew those changes at that time. Look, it's a significant structural change. I think we've had multiple governments talking about structural reform, and this has been labelled as structural reform. But in my view, we need to see a complete review of the tax system to be effective structural reform for the Australian economy, and we've not had that since the time that the Howard Costello government put in place the GST, for example. And prior to that, it was very much, the Hawke Keating government that did significant structural reform that seriously benefited the Australian economy at that point in time going forward. So I personally don't view this as significant structural reform, although the policies themselves are fairly significant as standalone policies and may not be actually having the effect that the government, the Prime Minister and the Treasurer are actually were hoping to have.
And it can have unintentional consequences, just like the CGT discount did back in the late 90s or early 2000s. I think that was aimed at encouraging share trading, and then it indirectly ended up supporting housing.
Yes.
And look, we can be a bit more controversial now that you don't have the Macquarie Bank job title.
A little bit.
And, in our eyes, the House's view here is this is just, a tax grab relabeled as, increasing housing affordability and whatnot. Investors hate it. Business owners hate it. First home up buyers can't see how it really improves, affordability. Let's and obviously tenants on top of that are now being thrown at the concept of rents going up. Let's break that down for all our listeners who don't actually know, what we're talking about in terms of these changes. I'm sure by now they've been bombarded with stuff on their algorithm on social media and on the news these changes. But let's call them out sort of line by line. So the big one, CGT, capital gains tax.
Yeah.
Costello was the one that introduced the capital gains tax discount in 1999.
Yes.
Which was basically if you held the asset for more than 12 months, it's a 50% discount on that gain. Most people always recognise the gain in housing above, let's say, the top tax bracket, which meant that they assumed that capital gains tax was, call it 23.5% once you apply that 50%. But
that original policy was really to motivate investment across asset classes, but a focus on much needed investment in housing at that time. And obviously the policy to hold an asset for over 12 months before you can get that benefit of that discount. Look, there is a couple of things that I think. The consequences that you've touched on are probably not exactly what the government was hoping for, or maybe they haven't thought it out as well as they should have.
Back in 1999, that was?
No, now, these changes to the 1999 proposals.
So let's actually call out what that change is, right? So we're going back to how it was formerly.
Correct.
With some slight tweaks with a minimum 30% capital gains tax. So let's talk about what that was. So instead of the 50% discount after 12 months on your capital gain,
yes,
now they'll apply inflation, the indexation of inflation annually to your cost base.
So the best example to give on that is if you're on a 40% tax rate, or effective 40% tax rate, in the old system, you held an asset for 12 months and you sold it, the capital gain would be discounted, the tax on the capital gain would be discounted on your 40% by half. In other words, you paid approximately 20% on the capital gain. So now the new policy is that it's going to be a flat 30%. So you're going to be worse off.
Well, you also have to, I think it's safe to assume all the capital gains tax calculations we've been privy and exposed to with our clients and even personally, you normally always recognise a gain that pushes you into that top income tax bracket that year. So that's why I say it's the 47 that's halved to 23.5%. So let's talk about how that indexation works on the cost base. So the cost base is what they calculate your gain off. So if you buy $1 million property and the property, you sell the property for 1.5, previously that's a $500,000 gain. The cost base is $1 million. You sell it for 1.5, you gain's the difference of 500,000. Now they'll apply the annual rate of inflation to that $1 million cost base, which could vary every year.
Yep.
And it compounds. So you still then don't pay, you still get some form of discount on the inflated cost base, you could call it. And the reason for that, that was in play pre-1999, it does make sense because if you held assets for a long time, over 12 months, naturally all asset prices do appreciate
with inflation.
With inflation.
Absolutely.
So it's not a real gain if you're calculating it off that fixed price that you paid 20 years ago, let's call it. So applying inflation annually to the cost base does make sense.
It does.
Just became very hard to calculate. And if you want to make a decision without speaking to your accountant, it's somewhat near impossible to figure out what your cost base is.
Well, this is one of the consequences of this is, amongst other things, is how you account for these changes and the cost of accounting for these changes. So the detail and whatever else. And so it's going to cost probably, you'd have to expect your accountants are going to charge you more to work out the calculations.
They're the definite beneficiary of these changes. they're going to...
Yes, but not the end user.
No, not the end user, but they're definitely, fees are going up and their service has become more valuable, that's for sure. So just to sum that out, so now there's a inflation applied to the cost base, and then the gain is off the real gain off the increased cost base with a fixed 30%, or no, a minimum, 30% as the capital gains tax floor, you could call it.
Correct.
But it's whatever income tax bracket you're in on that inflated cost base.
So you've got to ask the question, how does this policy change behaviours of property owners or prospective property owners, given the changes on the capital gains tax side. And so it begs the question whether, in fact, that people will not sell property. They'll just hang on to it because they want to pay the higher level of tax. Does that change the supply side of the property pool? Again, it's just a question you've got to be thinking about in that respect. And does it actually change people's perspectives? Well, they won't buy property. They might look to other assets. However, the tax changes also applies to other assets as well.
Yeah, so actually, I don't think that latter example will happen because they've kept the CGT changes across the board. They're equal across the board. So it's not like they, incentivized investors to focus on one sector rather than the other, meaning they didn't say, on shares there's a different calculation and the 50% discount still applies. These changes are across all forms of capital gains tax, which is causing the biggest uproar I'm seeing on social media, which I think the Prime Minister even had to answer in some interview recently, was about startups,
yes.
New businesses, because
Absolutely.
New businesses generally don't have a cost base. There's a bit of a misconception there where people think that, well, sometimes you might start a business and have to put $50,000 to $100,000 in working capital in, but that's normally expensed against your revenue. It goes on your P&L rather than a cost of acquiring the business or a cost base. So that means effectively you are paying up to 47% income tax on the sale of your business when you sell.
Yeah. And again, it begs the question, particularly around startups, and we're talking about investment, we're talking about innovation, something that Australia to some extent has been lagging behind the rest of the world in terms of having a viable tech sector, although clearly there's some good examples of what Australia can do in that area. But it does mean potentially that, a startup would go in, there might be a large capital gain available after 5 years, and where principals who've been involved in that startup haven't taken large salaries, but have been reliant on the hard work through a capital gain, and that's going to be penalised by the new changes in CGT.
So then moving on, so CGT changes remain equal across the board. So everyone who's investing basically is going to be paying more tax.
Well, there's been a couple of really good examples there because I saw some commentary of a fellow talking about his daughter who was aspirational to save a deposit for a home or an apartment, some property anyway. And the potential risk is that, she has gone and put some money into the share market, and the CGT impact of her building wealth, so that aspirational perspective of holding property, she's building wealth through the share market, through another asset, could be negatively impacted by the changes in the CGT. So she's going to have less amount of money for that deposit. So it's going to take her longer to actually save. So, these are real behavioural shifts and changes that could come about.
So that's one of these unintentional consequences
Correct.
that we've called out before, and we're going to get to that. I'm going to touch on, who this actually impacts, because a lot of people think we're going after the wealthy here with these changes, but no, it's actually going to impact all sectors of the economy, all classes. And that I rightly called out, the first home buyer now has a limited ability to save a deposit, especially if they're investing it. But also, if rents go up, that's the biggest cost for a first home buyer while saving the deposit. I want to move on in terms of summarising these changes.
Yes.
So we called out CGT changes across the board. Now at a higher rate, they're about to, you could safely assume, so no matter what you're investing in, you're going to be paying more tax. The next one, which was targeted toward property, was the negative gearing changes. Yeah. And this one's been, I guess, speculated or thrown around like a political football for years, almost every election. And in previous elections, some would say it cost Labor the election when sort of campaigning that policy change.
2019.
Yeah. When they said that they're going to make changes to negative gearing or CGT, it cost them the election. So it is quite frustrating for especially Labor voters that supported this government, that they were given the commitment and promise by this government that these changes wouldn't happen. And that it was promised countless times. It wasn't just one or two odd comments. I think there's videos also floating around on social media with up to like 30, 40 different questions and answers.
I think Prime Minister Albanese said for the 50th time no.
Yeah. And then has done exactly this, has then said no, effective as of, the CGT change is effective as of budget night, and negative gearing, you get 12 more months on any purchases thereafter budget night. But then as of July next year, 2027, negative gearing on purchases effective of budget night moving forward will not have negative gearing applied. That one is one that is going to hurt investors, because investors do rely on the gearing benefits for cash flow. A lot of them do.
And also to touch on, I know we'll talk about who it's affecting, but I think seeing that you've raised it, we've got to be saying that for those who are on PAYG and have some of those tax benefits that allows them to be aspirational and to buy into property, they are going to be impacted. And that's not necessarily the wealthy that's going to be impacted. So it's going to be middle Australia in this respect. So again, this is going to change behaviours around a focus on investments. And the implication of that, I think, Theo, is that we're currently in still a housing crisis. We are short housing. Dramatic numbers. We haven't seen the supply response that we've needed, and we continue to see ongoing significant demand. So you remove a tax incentive such as negative gearing, and you've got to be asking, why would people be going into new build property or committing to new build property where they haven't got a tax advantage?
Yeah, so that was a couple of things there to call out. That was their way of addressing the supply issue, which is we'll still allow negative gearing on brand new homes, units and house on land subdivisions, let's call it.
Yep.
But we still have record low supply, and I don't see this policy changing supply, because there are other fundamental issues driving that supply shortage.
And look, there's numerous, sorry for interrupting, but there is absolutely numerous factors around this supply issue. It's not just the fact that, but there's regulation, there's cost of building materials, there's been skills shortages, and it's also, we have to talk about the fact that demand has been rising through, to some extent, but not only, very high levels of immigration.
And on top of those things that you just called out, the factors that are limiting supply, you've also got councils and state government making it very difficult to getting out of the
regulation
ground.
side.
Yeah,
absolutely.
And on the regulation side, there's also fees and levies that end up being something like up to 40% of the overall cost of delivering a unit.
We talked about that last year, I think, and this is real. So if all three levels of government, federal, state and council, was serious about addressing supply issues on housing, you'd think that I think it's 38% of the cost of building a freestanding home is basically taxes.
Yeah.
You would think that they may look at cutting some of those taxes to support lower cost of building. And are they?
Yeah, no, exactly right. It's rightly called out, because the biggest issue is the feasibilities aren't stacking for these developers. They can't sell the units at the prices that purchasers are willing to pay. So I don't see affordability changing overnight if the feasibilities don't stack for the developers.
Correct.
And we need to bring the costs down to increase supply, to improve feasibilities for developers. And then that would open the floodgates maybe to supply. So just we digress there. We were talking about some who this impacted and some fundamentals there on supply, but the negative gearing changes. So this one, going back to, I guess you've already called out PAYG earners. We see here we've got close to 70,000 people in our database. We see here the bulk of people that rely on negative gearing actually aren't the ridiculously affluent. They aren't the super rich. Those people that have a lot of capital to deploy actually want cash flow on their capital. They want yield. If they've got a lot of debt, they don't want negative gearing across a huge portfolio of debt. They need cash flow. It's actually that middle class that needs negative gearing to cash flow an investment or two. And it's not like they're rolling in it. The negative gearing just makes the investment feasible. So now we're going to see, I think, our house's view is a bit of a change in mindset. Investors that do have capital to deploy are going to have these challenges on limiting wealth creation, no matter what sector they look at, or what asset class I should say they look at. So now if they are looking at property, the mindset they need to change is either a bigger deposit or a lower LVR or a combination of the two.
Correct.
So that the property is cash flow neutral or positive.
Well, there was an article in the press recently that the big banks, let's call it the big five now, are unlikely to include in their lending calculations the tax advantages of negative gearing going forward.
We've already seen that, actually.
So you'd be right at the coalface of that, Theo, in your business. So it'd be interesting to see how that changes. Demand for credit growth credit.
Well, I think that got down rated straight away, right? I think we have 4% credit growth forecasters that dropped to 2.
Yeah.
So your former employer actually was one of the first banks, Macquarie Bank, to announced that they will not factor in negative gearing into their servicing calculations, but they haven't given us a new servicing calculator. They just said your current servicing calculator is inaccurate. Be mindful. So we're staying tuned to see what impacts that's going to make. Just going back on that changing mindset, we're also seeing that our house's view, we think that we're going to see maybe more people looking at investments in their SMSF instead of having a negatively geared investment property in a personal name or a trust, just because there was no changes to SMSF, which we were quite surprised about. They'd already done the Division 296 changes last year or prior. So it feels like they've already, tightened up some taxes there.
But that also still has some issues in terms of investing and if you can't borrow and leverage into the super fund. So you've got to be talking about committing very large sums of your super fund, and you're going to be reliant on the rents coming back from that as part of the income component of the super fund. So the key thing for me here is there's a high degree of complexity, and to all of your listeners, please get some advice.
Get advice.
Absolutely, particularly if you're thinking of using the super fund vehicle.
And the advice goes beyond the accountant. Sometimes I feel like consumers rely too much on their accountant, and some of the advice that they're asking of their accountant is actually investment advice, and they need to speak to a financial advisor or a financial planner.
I think that's sensible. Yeah.
But just going back to that, you can actually get up to 90% loans now in SMSF entities. You can borrow in your SMSF to buy a property up to 90%. We don't see too much at that level. We see quite a lot at 70 to 80%. There's quite a lot of lenders now that have come to market supporting lending in SMSF structures, although that was speculated on whether that was going to be removed.
Yeah.
I just want to call out one last thing on the negative gearing changes, though, to conclude that tax change. So negative gearing, previously, it was the cash flow loss that would be offset against your income.
Yeah.
That loss is now not completely removed or unaccounted for, let's just say. Now you can actually offset that cash flow loss, that income loss, against your future gain, against the future capital gain. So you're kind of like banking your negative gearing losses for the future offset purposes. So it's not completely abolished, let's call it, but you just need to be in a better cash flow position than you did previously to be able to cash flow the investment property.
But I think and most people who are negatively geared are well aware of this, it's not only just the interest costs, but it's all the costs of effectively running the property that you would incur. Were part and parcel of that calculation.
Which is underestimated. A lot of people look at gross yields of residential investment properties. They look at the 3 to 4% gross rental yield, and they don't realise even at 3 to 4%, if you're borrowing 80% LVR at say 5.5%, 6%, you're aggressively negatively geared.
Yeah.
There's not just a little disparity there that you need to make up with land tax, council rates, or strata fees if it's a unit.
Correct.
Maintenance, general maintenance, because tenants are empowered with rights these days. It's quite negatively geared. Even at 3 to 4%, I'd say you could safely assume maybe negative 1% is net yield. So it's a good call out. So moving on, the other big one to just touch on is trusts. changes. The flat 30% now on all trust distributions.
So what's emerged post the budget, and there's been some press around this as well, is that quite a few families, and we're not, again, talking about the wealthy here, we're talking about the mums and dads, the sole trader businesses have used a trust structure basically to hold their businesses. And, this is now being potentially going to be impacted. So again, it's one of those probably not quite calculated impacts that the government might have intended.
Yeah, another unintentional consequence, because I'm glad you called that out. We see here in our business, even, small business owners, tradies, builders, carpenters, all those
Absolutely.
Business owners, they'll own their business in a trust, and then they'll just distribute that income to their family.
Correct.
To take advantage of those different income thresholds.
And it's been referred by the government that they're wanting to basically target or ensure people meet their obligations. But that has been the tax structure to date. It's not as if people are avoiding tax. They've been working within structures that's been perfectly viable and allowable. But unfortunately, it does beg the question whether, once again, this impacts, aspiration.
And if we're going to get political, I'm sure all the supportive wives out there wouldn't mind me saying that there's a lot of wives that don't necessarily earn an income directly, but they are supporting their husband, or vice versa, a husband supporting their wife in a business, and that allows them to earn more income. And then that's how they distribute it, because they're a family unit. They distribute it through the trust, and as a family unit, they should wear that income as a household.
But again, it would appear that, and while we're sort of being somewhat political, the consequences of this is this inequality that the government has been talking about. Again, I just think that they haven't really thought this through, or maybe its Treasury hasn't thought it through.
So, and to I guess conclude those changes, all those were labelled as improving housing affordability, tightening on investor activity in housing. It was a tightening of investor activity, full stop. It was a tightening of any form of wealth creation, full stop. The next generation, people moving forward, are going to struggle to create wealth in the same way that people have for the last few decades.
And there's absolutely no doubt that housing affordability has gone through the roof. So it has been more and more difficult for young families to buy their own homes. There's no question about that. And it'd be great to be able to address that. I just think it's actually quite a simple solution, which is you've got to increase supply and reduce, to some extent, demand. And I'm not convinced that these two key policies we've just been talking about will actually have the desired effect in the scale that's required. So again, let's just put this scale in perspective. Given current immigration that we've been seeing over the last number of years, we've been building about 160 to 170,000 new dwellings a year. Given the demand from that immigration, we actually need to be building more like 220 to 240,000 houses today, and we're not. And look, there's a number of reasons for that. Obviously we've had interest rate rises, cost of building materials been up 30 to 40%, and we've got skills shortages. So they're all real issues around, getting new housing built, both high density and single dwelling. But we aren't seeing the response we need to see on that supply side.
Yeah, well, reducing taxes or levies will definitely be
it would help.
A better way to address that supply issue.
Yeah.
And on the migration story, I hear you loud and clear that the migration just makes the affordability only a bigger issue.
I think it's just a personal view. And so, again, without getting too political, this fabulous country of ours has grown on immigrants. My father was a European immigrant post-war. We need immigration. We need to grow the population over and above the natural birth rate. But we also need to be targeting who's coming in, who can add to the prosperity of this country. And I think here's one little statistic I just happen to know, Theo, which I find interesting. I think in the last 12 to 18 months, we've had about 700,000 people come to Australia. Just have a guess of how many electricians of that 700,000 came to Australia.
Well, I was about to say previously to your point that I thought the whole point of this migration was importing, you could say, the appropriate skill sets, and with a focus on housing.
Yeah.
So I would have thought there'd be a large percentage.
You'd like to think so.
Yeah.
Yeah.
Now that you've made me, now you brought this to my attention, I'm going to guess it's like 2 or 3%.
1,000 came in out of 700,000.
Wow.
And we probably need 20,000. Currently with the big infrastructure spend that's taking place, and that's much needed because we've got a growing population, and infrastructure has been way behind the 8 ball for a long time across all state governments. But here in New South Wales, that certainly has been the case. That sucked basically skills away from residential building and development into the building of the infrastructure, and makes some sense. But, to rewire Australia for the new energy plan, we're going to need thousands and thousands of electricians to assist in that. And they're just not coming here just yet. So that needs to be targeted.
So before we go into,
I'll get off my soapbox now on that one.
No, that's great. I like that. That's the whole point of this episode, Martin. That's why I think you're one of the most repeat visitors we've had, or guest speakers we've had.
Thank you. Well, I'm flattered.
So before we get into who gets affected, let's just also highlight, so far what people are saying as, the likely outcomes of these changes. We've touched on a few of them, but just to further elaborate, rents. So when a lot of people are saying rents are going to go up from these changes because naturally owning a investment property is going to become more expensive.
Correct.
We're probably also going to see a reduction in supply of houses
properties
to rent.
Correct.
So if there's less supply, more demand on that reduced supply, prices go up. And this is exactly what happened in the late 80s with Keating. And the reason why it didn't pass legislation is because we saw a huge increase in just 12 months.
Look, I've not done, it's almost impossible to actually do a calculation, but for what it's worth, I think Treasury is talking about a 2% rise in rental prices as a result of this policy. The Grattan Institute, I think, is talking about 4%. I suspect it's going to be closer to 10%.
I didn't see the 2%. I thought Treasury talked about $2 a week increase,
right.
which doesn't seem accurate.
Which is minimal.
Yeah. So, we think rents are going to go up as one likely outcome.
Yes.
Probably a reduction in investor activity in general. Some people are saying that we might see investors look at other markets where there's actually more favourable tax environments. We talk about startups now actually registering potentially in Dubai. We might see some migration changes there. So then that's a good segue into who this actually impacts. So we've touched on it, but people think that first home buyers, this policy, these changes were labelled as a affordability solution, but I don't see affordability drastically changing if first home buyers now have to pay more rent whilst accruing a deposit, while saving a deposit.
That makes sense.
On top of that, you rightly called out, if they're investing in shares, which we naturally see a lot of, first home buyers investing in shares while
build a deposit,
while saving a deposit. Then when they do crystallise that deposit and sell the shares, more tax is payable.
Yes.
Especially if it's over a shorter term now, because the indexation of inflation is not going to really increase.
They won't get any benefit on the cost base.
Yeah, exactly. Yeah. And we see people sort of saving up a deposit maybe over 2-3 years in share trading. And if that could just be index fund, buying the ASX, which still helps a little, right?
So the other thing is that I think has been in the press, but I think it's worth just commenting as well. So there's obviously the budget is driven by both politics and economics, and certainly the part of the political side has been this talk of the government's trying to address intergenerational inequity around property and the affordability and the ability for the young people and young families to buy property. But the question you have to also say is that the baby boomers and Gen Zers and maybe even the Gen Ys have had the benefit of these policies. And those benefits are now changing for the next 10, 15, 20 years, or unless they get repealed. So although there's maybe in the government's mind's eye short-term benefits to housing, you and I question that, But the aspirational side of building wealth for families has now changed.
And if the lower income earners already felt that the disparity between the high income earners and the ones that are, let's say the baby boomers and the ones that own all the wealth was already a problem, that's just going to make them feel further behind if they can't get there with the same incentives.
With the same incentives. Correct. Or the same advantages.
Yeah. So we've just made it harder for people to catch up.
I think that's right.
We've made it less attractive to actually look outside the box and look at, creative ways to invest and, just incentivizing investing in general. And let's also talk about investing does have its own benefits to the economy. When we do have people investing in shares, housing, all forms of asset classes, there's a consequence to economic growth.
So investing, the basics of investing is there, as you full well know, is about risk and reward. And so if investors, whether they be young, trying to build a deposit, or old, trying to build wealth for their retirement, they take on some risk for some future rewards. Well, again, you've got to be asking, where's the incentive for that?
Yeah. So we've just now talked about, I guess, lower income earners and the first home buyers. I can't see a drastic improvement there. The one thing to sort of fairly call out, generally where first home buyers buy property are in the same marketplaces that the investors are buying. And so we will see...
That's a great point.
Yeah, we will see a reduction in competition. So they've got a better chance at securing properties in those markets, let's say. I don't see a drastic change in price. Maybe just, unfortunately for them, less growth if there's less competition long term.
Yeah.
If there's less demand, less growth. So they're not going to have the same growth that the previous generations of buyers had.
Look, we've seen a softening in the property market, particularly in the capital cities of Sydney and Melbourne, probably in preference towards seeing better property price movements in Perth and Brisbane, southeast Queensland. So we've already, pre-budget, we've already seen a slight softening in pricing. But given the demand dynamics we've talked about and the lack of supply, it is hard to see property prices dramatically fall from here.
Yeah, we'll get to that in our macro sort of summary, where we did have a sort of a weak economy, low confidence and low sentiment moving into this budget. So, now there's going to be consequences post the fact. So we've called out, the only probably benefit I see on the first home buyers is less competition. Auction clearance rates are already low, so they already had that benefit. I think we saw it got down to about 45% in Sydney, I believe.
There's an estimate, I think this weekend is going to be 32, 35%.
Coming down. There's some negative headlines out there, that's for sure. We've already called out, so the middle income earners, it's not just the wealthy that's going to be affected by these trust distributions.
Correct.
Small business owners and also POIG income earners. They're the ones that focus on negative gearing benefits. They're the ones that try and get some tax back from negative gearing strategies. So they negative gearing, CGT and trust changes all affect them. And then the thing is with the wealthy, I don't think they care too much about the 30% because if they distribute out to individuals, and on top income tax brackets, they pay the difference anyway.
Yeah.
So I don't think...
That's probably right.
Yeah, I don't think they really got who they wanted to get.
No, that's probably right.
So, yeah, I guess any other call-outs there on who this affects unintentionally?
No, I think we've touched on it. And I think that, again, it falls in that guise of, unintentional consequences that maybe it hasn't been thought through as well. I think when we think about the rest of the budget, these were key headline-grabbing issues. But the rest of the budget, interestingly enough, really didn't. We've seen an increase in spending by the government in for example, in defence and housing, health, which is very important, particularly on the health side. But we haven't seen a commensurate reduction in spending, and that's been one of the criticisms of the government and how they've been managing the economy, because it relates very much to inflation and relates very much to how the Reserve Bank is viewing inflation and interest rates. And so this gets tied into, again, that whole issue around affordability for first home buyers. And without seeing any significant movement on the balance of the budget, and we're now running a pretty big deficit, so lots of spending, and they're now trying to claw back slightly higher levels of tax, it's very hard to see inflation coming down anytime soon, particularly, and we'll talk about it a bit later on, what's happening around the global economy. But, this is not just the global economy that's in fact affecting Australia's inflation rate.
Well, they say that also this is, somewhat of a tax grab because of the government spending that's put us in a record amount of debt.
Correct.
Which we'll get to. Just lastly to call out actually something I forgot to mention on the high net worth or the wealthy that have been impacted from these tax changes. Most of those people actually have very complex self-employed structures with trusts and whatnot anyway, and they can somewhat still offset losses in trusts and companies amongst each entity. So that, once again, not the biggest change. Well, there's still some impacts, but don't think they've landed that one the way they wanted it to. I also want to call out that the language leading into this budget was very different to what we saw after the fact. So I'm not just talking about the promises made getting into election, coming into the election. I'm talking about Jim Chalmers specifically said they will grandfather negative gearing, they'll grandfather capital gains tax, and negative gearing will be from, they're considering after the second investment property. None of that happened. No. Negative gearing is just abolished.
Yeah.
The grandfathering, you could sort of say, is how they've done the CGT, but not really.
Not quite.
They were
partial.
Yeah, they said that it was on new investments. That's not true. It's current investments on the accrued gains moving forward. That's not grandfathering.
No, it's not.
Yeah, so very different outcome to the comments and language used on countless forums leading into the budget. So let's talk about, I think we've already touched on it, but next point was going to go into housing supply and the rental market consequences. So we've already, sort of somewhat called out a reduction in supply would put upward pressure on rents. What are the other sort of, consequences you see coming out of this budget?
Well, in broader terms across the budget, look, Australia is a relatively small economy. We're a cyclical economy. We rely on the global economy doing reasonably well, particularly for our in our mining side. We know we've seen a significant reduction in our manufacturing base here in Australia, and so we're very much a mining and services based economy. And so we are at risk if we have a significant downturn, given our budget deficit and our very high level of debt, hitting or about to hit $1 trillion. Now, we had basically no PSBR, that's public sector borrowing requirement, through the Howard Costello government. And so basically since 2007, when the Rudd government came into place, we've seen Australia's debt grow basically from almost zero to $1 trillion. And, this has to be viewed as a real concern for our economy going forward, given that we are very much exposed to the ramifications of what happens around the rest of the world. We are not really, we don't control our own destiny. So that does concern me from a big picture perspective.
Especially if I feel like Australians are more reactive to interest rates in the economy than some other marketplaces like the US, because it's the Australian dream to be a mortgage holder, you could call it.
Well, there's a really good reason for that.
Yeah.
Sarah. In the US, most homeowners have a 30-year mortgage.
Fixed.
So if they've caught a downturn in rates, some mortgage holders might be on 2 or 3% for 30 years. So although mortgages are, still have to be paid and serviced, they know where they are. We find ourselves, and you would know, through Shore Financial, what's the average term of a mortgage? Is it a 5-year?
Well, you still get 30-year mortgages, but they're variable.
Correct.
And if people do take fixed, it's normally between 2 to 5 years. And with most people fixing around the 2 to 3 years. But fluctuating interest rates in America more so affect the corporate and businesses
rather
sector,
than the mortgage sector,
rather than the individual houses. My comment where I was going with that was that if the unintentional consequence of this budget is that it's the middle Australia that gets most affected. In a downturn, they're the ones that don't really have a healthy buffer to go through some tough times. The wealthy Australians, normally have reserves and just, I guess, a contingency plan, worst case scenario, to get through tough times.
Yeah.
So if we've already had a weak economy going into this, and now we're going to, see maybe further downturn, that middle Australia are the ones that are going to feel it the most.
They will feel it. And they've been feeling it for some time with the cost of living issues as well. And obviously, out of Australia's control, but the Middle East conflict obviously has pushed energy prices significantly higher. Let's hope it doesn't last too much longer. But that's having an impact on cost of living, and it basically takes more out of the family budget to be doing other things like servicing a mortgage or servicing an investment loan or growing wealth through contributing every month into an investment.
So we've actually naturally segued into what we wanted to move on to, which is a bit of the national and global economy and a bit of a macro lens on things. Let's talk about what's going on, locally first. We've been battling inflation with interest rates for 5 years now, it feels like. And as it stands, I think we've got 1 to 2 rate rises still priced in by markets for the end of the year.
Yeah.
Inflation's still stubbornly hot. Well, it reignited recently, I should say. I think the most recent quarterly data showed about 4.8% in the headline.
The headline, yeah.
Yep.
Yeah.
And that was pre-fuel prices. Oh, no, I think it had 1 month of fuel prices.
It might have included 1 month.
Yeah.
Yeah.
How's this now going to, how's this all playing together with, already a bit of a tightening going on? I feel like the next quarter of data, we should see a reduction in spending. We should see some decrease in inflation, and hopefully those forecasted increases might be off the cards, is my hope. And we might actually enter an easing cycle sooner than expected.
Look, it's when you look at the calculation of inflation, and I think we talked about this last time we got together, the Reserve Bank, although they take note of the headline inflation, what they look at is what they call the trimmed mean. It's basically it's an average inflation rate, and they try to take out the volatile items.
Which is the top 15 and the bottom 15%, right?
Well, it's also they look at things like energy prices are naturally volatile. There might be a time when there's a flood or a drought and certain food prices go up, but that will be resolved in the fullness of time. They'll take that volatility out as well. And so they're looking at a longer-term average price. That long-term average price did very briefly go into the range by which the Reserve Bank wants to manage inflation, and that's 2 to 3%. But it was very brief. And now we've got that trimmed mean, or that average rate, and now well and truly outside of that range, back well above 3%. And while that's the case, it's very difficult for the Reserve Bank from a policy perspective to be doing anything but either keeping rates on hold where they are, or in fact raising rates if they're concerned there's more pressures coming through on the inflation rate. And with energy prices, the longer we have this Middle East conflict, you've now got Brent crude at $110 a barrel. It was $60 prior to the conflict. It's very hard to see that inflation number moving down while we've got that in front of us.
We spoke about this in a previous podcast. So I don't want to go on about it too much, but some of those drivers of inflation are somewhat irrelevant to the RBA's monetary policy. You've already called it out. Energy and electricity prices being some of the biggest movers year on year. Electricity was up 20%.
Yeah.
That's a supply issue. That's, the change to renewables. Insurance, it was
Insurance has been huge.
20% year on year. I think
healthcare costs.
Almost 2 years in a row.
Yeah.
And that's just mainly also because of increased claims from climate-based change. Climate change-based claims, and then and also the increased cost of replacement on building values, and then other drivers like housing. The housing was cost of brand new homes and rents. Interest rates aren't going to help any of these things. Higher interest rates. So,
and look, they're mindful of balancing, both in terms of the needs of the economy, but keeping inflation under check. And I guess to some extent there's been some discussion about this terrible economic word called stagflation, where stagflation is basically you've got slowing growth but rising inflation. And so that is so difficult for central banks around the world, not only our own Reserve Bank, to manage a stagflation environment. Now, I don't think we're heading towards stagflation. The global economy has been far more resilient than most analysts and economists had been anticipating. But there are some issues here. If we do go through a period of slowing growth but inflation remains high, what do central banks do? Normally, when we have a slowing growth environment in economies, they want to assist by stimulating and recovering growth. So they cut rates. But what they normally do when inflation is high, they have to raise rates. Well, they can't do both at the same time. And so it's a real conundrum for central banks. And we're hoping that that's not going to be the case. But here in Australia, we continue to grow well below our optimal rate of growth. We normally grow at between 3.5% and 4%, and we're growing around 2%. So the economy is not really firing.
No.
And then when you look at confidence, both at the consumer level, and we were talking before this recording, Theo, the consumer confidence at the moment, or household confidence, is now lower than it was at the time of COVID and lower than the time of the GFC. So households are really feeling it.
It's funny how the data gives mixed signals, and the RBA has one lever to pull, being interest rates on inflation, and people would say that the inflation data is meaning that the economy is running too hot. And to your point, GDP says a different story. I guess unemployment's remain competitive, but it's ticking up, and we're expected to see a lot more unemployment coming, or an increase in unemployment from AI. To call out numbers there,
well, not just AI, but it's also around productivity
of course.
Yeah.
But to call out numbers there, it's only 14,000 job cuts thereabouts moves unemployment by 0.1%.
Yeah.
So we could easily see unemployment shoot past 4.5%.
Absolutely.
We're not far off that now. Something you touched on there, which I want to elaborate on, and it sort of ties back to our earlier comments on the budget. Balancing, the economy and balancing inflation. The big one there, the government spending. I didn't actually quite get a chance to fully digest some of those changes, but I believe in the federal budget they are easing some of the government spending, which should hopefully help the inflation story.
The big headline one is this review on the NDIS, where they're wanting to see the rate of growth of spending in the NDIS be curtailed over the next 10 years.
Halved, wasn't it?
Yeah. Well, that's the current plan. Whether they're actually able to execute that plan, and that's at the end of the day, the NDIS it's established by Julia Gillard for absolutely all the right reasons to assist those who are significantly disabled. But unfortunately, the system was too broad, or the structure was too broad, and it's been open to spending and rorts and all these sorts of things which need to be pulled back. So that will add to some extent an improvement on the spending of the government. But one of the big areas of spending that also affects the economy from a productivity and growth side is we've seen a significant shift in the size of the public service. And again, what's the economic benefit? And certainly there's question marks around how productive and what the commercial or economic benefit from an enlarged public service is. So again, these are areas that are not being addressed by the government.
So I guess moving on and trying to wrap up this the state of the global economy in a macro lens, let's look at other markets, because Australia's quite different right now from other markets. Our ASX is off all-time highs and hasn't gone back there. I think it might have been around February we're at all-time highs. And we haven't quite recovered from the Middle Eastern war, where other markets, you look at
particularly the US.
The US is still filling the AI tech bubble. The NASDAQ, those magnificent 7 stocks are hitting all-time highs.
Yes.
But their economy as a whole seems to be performing better. Would you say?
Yeah, look, it is. It's holding up reasonably well. We haven't seen a dramatic shift in employment or unemployment in the US. But let's tackle those two things separately. From a market's perspective, the US market, it's no longer the broad-based rally that we've seen. It's very much focused and a narrow focus around technology, and in particular, as you rightly noted, AI. My concerns from a risk perspective is that we've seen these ongoing significant announcements of investment in AI. And it's probably necessary at this stage of the cycle, but without necessarily seeing the commensurate, take-up of AI relative to the spend.
In terms of revenue growth.
Yeah, in terms of revenue growth. And, even, dare we say, can we talk about profitability? Probably not just yet.
But just revenue would be good for now.
But we have seen a quarterly reporting season in the US that, again, has beaten expectations. So that would have to say the underlying broad brush US economy looks to be okay. And that's that resilience story that that's been playing out for quite some time. But the market's run hard. It has hit recent new all-time highs just last week. And so there has to be a concern both in terms of valuation and where the economy is relative to where the stock market is. And so, I think there is a potential risk, certainly not talking of a crash, but certainly talking of either a consolidation or a pullback at some stage. I think that's a risk. But you've got this combination of real earnings coming through in some sectors and a massive amount of investment, particularly around AI. Also, the key dynamic that's changed, you've called them the Magnificent Seven. I actually label them the tech utilities because we can't go through a single day without using the cloud. So that's Microsoft or using Google or maybe even using Amazon. There's so many of those companies, NVIDIA, all of them, right. So they are now businesses that we can't do without. And so that's been a dynamic change. Globally.
Yeah, absolutely. Every marketplace now uses the Magnificent Seven.
Yeah. So we don't have that technology sector in the Australian market, not to the extent that it dominates the US markets.
And I guess lastly, just to conclude today, because we are running out of time, unfortunately, the one thing that we're seeing that's probably consistent across marketplaces is, I guess, a bit of a flight to quality from investors. And we're seeing various ways that's happening. Globally, we're seeing private credit become a bit hit from a lack of confidence in the assets private credit has lent to, mainly the corporate fund. So when private credit or private lending businesses are doing corporate lending, now with AI disruptions, they're worried if these businesses are actually worth what they lent against as a valuation, let's call it.
Yeah.
So there's been constant write-ups in the AFR about the private credit space having huge amounts of redemptions or withdrawals in their funds because of that concern.
Yes.
And it's funny, the lack of confidence can then cause concerns, as in it can cause issues with these private credit businesses.
Hasn't that pivoted? Because it was only sort of early part of this year, late last year, that that's where everyone was focusing in on private credit. I think we have to be very careful when talking about private credit in throwing everything in the same bucket.
Yeah.
Because then you'll throw the baby out with the bathwater, so to speak. So, again, I think you're right that there might be some private credit funds that have got riskier businesses on their books that they're lending to, or other riskier assets that they're lending to. But there's also plenty of funds that do significant due diligence on businesses before they lend. And so I think that from an investor perspective, the best thing I could say is take advice and make sure that the recommendation is being spelled out to you and of what the risks are in investing in private credit at this point in time.
What about any other call-outs on flight to quality in terms of investors being reactive to the recent, couple months of war we've seen and I guess geopolitical issues and concerns and general investor sentiment being weaker?
Yeah, I think that's right. And I think to some extent the banks have actually been holding up pretty well. But again, you've got to view the bank sector as a whole as to some extent a reflection on the economy. And so if we're taking a view the Australian economy is going to slow or is under some pressure, and in particular with these potential budget changes that might see credit growth or lending growth slowing somewhat, that's going to impact the banks as well.
Yeah,
So
we saw all the banks drop the next day after the budget. CBA actually dropped 7%, but that was for some other reasons and some reports I think shared. But then all the other majors were 2% off.
So it's not that there's a quality issue around the Australian banks. It's not. But I think from an operational perspective, I think investors are starting to think about the banks have run hard and what's the outlook for the banking sector over the next 6 to 12 months. And it may well be there's a bit of profit taking to be done.
Well, I think, Martin, we didn't quite get to all the various things I wanted to talk about today.
You had an incredibly long list, Theo.
Yeah, we had a big list, but I think we've summed up, our views and the House's views on these federal budget changes, and also then from a macro lens on what that's going to do to the economy. So, Martin, thank you once again for coming back onto our podcast. I'm looking forward to getting you on this podcast more often now that you don't have the Macquarie Bank job title. We can get a bit more controversial.
Thank you.
So, in 12 months' time, let's review some of these comments.
Absolutely.
And I appreciate your time once again.
Thank you for having me, and I'd love to come back.